Learned is that when it comes to Code Section 212 and the allocation of expenses pertaining to tax-exempt income, because it's two different tax players at play, Manufacturers Hanover showed us or demonstrated to us that we're going to have to, the ordinary disallowance rule will not apply, and we have to do the special numerator with tax-exempt income at the top, the denominator taxable income, but because D&I under Code Section 643 doesn't generally include capital gains, nor will it include it here. So the authors, as I told you, and I'm hoping by the end of today, beginning at the end of today, by the end of tonight I should say, I'm beginning on page 57, the examples that are illustrated there, hopefully will really hone in today. And again, I'm hoping, where I said in prior classes you were a little potentially lost, hoping that will no longer be the case. So I'm putting a tremendous responsibility on my shoulder. So we talked about Manufacturers Hanover and the cases that followed that looked at some fees that were lifetime in nature. So we have the Whitmore case and the Favens case, which go beyond what Manufacturers Hanover suggested, and at least in the case of Favens, said that the denominator could include unrealized gains as well, unrealized gains. All right. Deduction for personal exemption, we took a look at, could be pre-trust, complex trust generally 100, simple trust generally 300, but a complex trust that pays all of its income currently can get a $300 exemption. I repeat, complex trust that pays all of its income can get a $300 exemption, I should say. And the states have a $600 exemption. Income for charity, okay? You get a deduction, not a charitable deduction, a deduction provided under Code Section 642C. We say with respect to depreciation, that the depreciation amount generally flows to whomever gets the income. However, if the trust has a reserve, the depreciation or depletion will stay embedded in the trust or estate to the extent there is a reserve established. And again, tonight, I'm going to give you a little taste, a practical taste of where that's all coming from. So authors give us a look at that. I'm going to see if there's other things. Two other items to call to your attention is that recall that expenses can be deducted either on the estate tax return or the income tax return. So if the decedent has to file a Form 706, which in the year 2016, the threshold amount is $5,450,000. So not too many of your clients are going to have to file an estate tax return. So most times, guys, the administration expenses should end up on a Form 1041. But they have to be deductible in nature. Funeral expenses, which are not Code Section 212, would not. For example, as illustrated in this Schiefer case, I don't know if I pronounced that right. Found on page 101, would not be deductible. Passive activity loss rules, we said, apply to trusts and estates, but the court, at least to date, has taken in this Matty Carter case favorable. Let's define this from a pro-taxpayer perspective. We sort of left off on Chapter 3. The entity as a conduit. Any questions on the material? You guys are good? Right. As we said, a large part of this course is devoted to this issue of who should get taxed, right? It's not a question of how much or things like that, right? And one of the pivotal or distinguishing aspects, right, of trusts and estates is embedded in this chapter 3, right? This concept of D&I, right? You are able to really understand and master D&I. That will be a tremendous advantage to you. And keep in mind, again, just I'm sure you guys out, the operative code sections with respect to simple trusts are what? 651, 652, right? Simple. And then Zal for complex?
661 and 662.
661, 662, right? One's a deduction on one hand, one's an income inclusion, right? There is truly, some of my tax classes, I talk about the asymmetry of tax, right? That, for example, your employer can deduct money payable into a 401k, but you don't have to pick it up in income, right? Everyone agree? At least not immediately. Notice the asymmetry. In direct contrast, when it comes to simple and complex trust, these code sections are designed to function in sync. Everyone agree? 651, 652, simple. 661, 662, complex. So Patrick, which regime, my left hand or my right hand, applies to estates? We just said trust. Which one applies to estates? Which regime?
You said trust.
Well, we said simple trust, 661, 651, 652, and complex, 661, 662. Which of those two regimes? You got a 50-50 choice here, and Anthony, see if you agree.
661, 662.
Anthony, agree or disagree? Yeah. Estate's generally going to be taxable as complex trust. Everyone agree? Because I worked on lots of estates before. They never say pay out all income, okay? And just, I've already said this, but it bears repetition. Every simple trust ever created at some point will become a complex trust. Everyone agree? So by their nature, at some point, simple trust will become a complex trust, even if it's just the last year, right, Patrick?
Right.
Right, so just bear that in mind. And one other thing, I'm not into simple factoids, but on the other hand, some of this, I think you guys, once you're done with this semester, you got to make sure you debunk myths out there. And certainly, Tina, the myth that you may have heard in the past, or if you haven't heard before, you may hear in the future. Do simple trusts pay tax? And if so, when? Once I get Tina?
Simple trust distribute all income.
That's true. So do they pay tax or not, Tina?
No.
No. Yoni, you agree or disagree?
Not sure. On termination?
Brett?
I don't know about never, but not on the distribution of the D&I, right?
Visa? When?
I don't know.
Yep.
If the simple trust has capital gains.
Capital gains, right, guys?
Yeah.
Ah, Tina. All right, you ready? Because when you finish this course and someone asks you that question, if you answer correctly, you had my class. If you didn't, who sold it? Okay? But you got to get that one right. Agreed? I mean, again, it's a very common mistake for people to make, to hear the word simple trust and think, oh,
They don't pay taxes.
they don't pay taxes. But that isn't true, right? Do you understand? No. All right, so just make sure that you guys understand that, because the D&I doesn't generally include the capital gains, and as a result, that will not be pulled out, okay? It will remain embedded in the trust, albeit a simple one, and it will pay tax. All right? So that's, and again, if I'm repetitive, that's okay, because you guys have to really nail that. Okay, income or bequest. Okay, that's how this chapter starts. And recall that we had this very early Supreme Court case from 1925. The code is still in its infancy. And remember, we have Code Section 102A. You guys remember from your income tax course says that the receipt of a gift or bequest is not subject to tax, right? In contrast to Code Section 61, right? And if someone bequeaths you, this was an unusual case, I have to say, to me interesting. I drafted a lot of wills. I'm going to make up a number, but minimally 2,000 wills. And I've looked at probably 2,000 wills. The number of wills I see where someone leaves money to a son-in-law or daughter-in-law, can probably count on 2 fingers, okay? So, no offense if you're married in this room, chances are your in-laws aren't including you in the will, okay? These, are you married? Do you think your in-laws are going to include you? But that goes for me too, so I mean, don't take offense. It's just,
already excluded you.
they're already excluding you. But again, it's not typically on purpose, okay? Just everyone know that. Because they're always fearful, right? The wife, if their son, God forbid, dies prematurely, you'll remarry and their wealth will go to the next guy. So that's always the concern. All right, so it has nothing to do with you. Anyway, the money's here. We're held in trust for the son-in-law, right? He had an income interest. And that's it. And the question, he says, look, that's sheltered under Code Section 102A. Well, the equivalent, because remember, this predates the 1954 code. And the question is that truly sheltered under Code Section 102A? And we know, at least the court here can't rely on or lean on Code Section 102B, because there was no Code Section 102B at the time. But nevertheless, the code says, well, that doesn't fall within the scope of a gift. It's income on the gift. Congress subsequently drafted Code Section 102B that would exclude it anyway, okay? So income on a gift or bequest is not shielded from tax under 102A, right? No one's falling off their chair, that's a good sign. All right. Harkness v. US. Here we have, let's say husband died, and he leaves half of his estate to his wife in trust, and the other half to his children, okay? And just to tell people or remind people that why did he do this? Because at the time, Code Section 2056 that deals with the estate tax marital deduction. Right now, after 1986, it was made unlimited, 84 or 1986. Prior to that date, the marital deduction, the estate tax marital deduction, was only equal to 1/2. Okay, so many estate plans that predated 1986. And you're not going to be tested on this. I'm just making an observation. This is not a course on trusted estates. It's a course on trusted estates, not the taxation, not chapters 11, 12, 13, and 14 of the code. All right, subchapter J, guys. That's where it's at. My point is that this estate plan fits the bill. Is very typical in nature because it leaves money. 1/2 to the spouse, and the other 1/2 to the children. And the trust earns income. Okay, the trust earns income. It earns about $800,000 income. Earns about $800,000. And the question is, whom should be taxed on that $800,000 of income? By the way, can I make an observation about this case? The tax return was filed in 1955. You guys notice what year this case was decided? Holy McGill's. I mean, I don't know if anyone's still alive. Who knows? But I mean, close to 20 years to get final resolution on this. Wow. Talking about the wheels of justice moving slowly. You would not be a happy camper if you were the taxpayer. I can't explain why it took so long. Whatever. Just want to call it to your attention. All right. So the issue is who gets taxed on that $800,000, right? And the choices, right, guys, are not hard. We could tax it to the estate. We could tax it to the surviving spouse. We could tax it to the children, or we could tax it some to one of the three, right? Those are our choices, right? But somehow, from the code's perspective, $800,000 should be taxed. Agreed? Agreed. And the wife here, through her counsel, and by the way, this was no small potatoes given the year involved, because this is a $27.5 million estate. So that's a half a century ago, so you can only imagine what it would be worth in 2016 dollars.
That was only half, right? She got half.
Yeah, right. That was only, you're right. It's 36 million, excuse me, you're right. 36 million. Actually, I'm going to stand corrected. The dollar amount has to be larger because that's even after taxes, okay? Yeah, it's like 56 million before taxes. I don't know if they give us that number, but the total here was no small amount. So here's the issue. The wife, the trust for the wife gets about, where it goes out, it's about 27.5 million. The trust for the children get 8.5 million. Okay. So this figure is about 76% and 24%. Right? Approximately. And we have D&I of about 800,000. So if you do the arithmetic, the IRS says that she should be taxable on approximately 600,000 in the D&I, and the children 200,000. The numbers are a little bit off, guys, but you get my oversimplification. Now, the issue, again, the taxpayer, that's the IRS position. Everyone agree that's the IRS position. She physically gets 27.5 million. The trust for the children get 8.5 million. And there's this concept of D&I that after 1954, you don't trace money any longer. In other words, it doesn't matter if you call it income, you call it principal, you call it what you may. The code looks at the distribution, and the larger the distribution, the correspondingly larger the amount of the D&I that you pull out. Agreed? But the wife says, look, I'm entitled to half the principal. And by the way, let me just make one other observation. Why did the kids who are entitled to half the principal only end up with 8.5 million? Because the estate tax back when was 70%. Sometimes it can get in excess of 70%, the estate tax rate. All right? You're shaking your head, Dale.
That's just crazy, that's all.
Well, I
I'm
mean,
not disagreeing with you, it's just, absurd numbers.
just so you know that, and we could debate this, but we won't all night. Why was there an estate tax ever instituted in our country? Which, by the way, just celebrated its 100th birthday, the estate tax. The estate tax was instituted in 1916, literally just celebrated its 100th birthday. The notion of the estate tax was supposedly consistent with the underlying tenets of our country, was that
To go into war.
well, that everyone should start off equally. You may not finish equally, but you should start off equally, as opposed to England, which had these dynasties that just lasted forever. So the estate tax was designed to level the playing field. And even if you take away 70% of someone worth $1 billion, the kids have a slight head start, at least over me. I can't speak for you, Joe. Anyway, just keep that in mind of the psychology behind the estate tax. All right, that's now tonight's lesson. So Dwight says, look, so notwithstanding the kids got a lot less money, that had to do with the federal estate taxes. That's why this disproportionate, but I'm only entitled to get half the principal, and as a result, I should be taxed on half the income. Okay, that's the wife's argument, right? Everyone see the wife's argument? And she makes several, different attempts to convince the court. Let me just give you the outcome here. She loses. The court is very definitive and says, look, we're not getting into tracing anymore. She says, look, the money that was used to pay taxes, the 19 million or whatever the dollar figure was to pay taxes, that should constitute distribution. But if D&I pulls out with the tax payment, it's not like the U.S. government can be issued a K-1. So that doesn't fly. The taxpayer points out that there was no ill motives here. The court also points out they could have planned this better. Remember, at the time this case was rendered, who was the best taxpayer to probably bear this tax burden? Who would have paid the least amount of taxes? Had this been thought about beforehand? If you recall, the estate was traditionally at a lower rate than the individuals, right? Everyone agree? Because it was considered a separate taxpayer. So with a little bit of planning, they could have left this income in the trust. Okay, watch this. In the estate. And the year that it was going to be, the year they were going to close the estate, like just suppose this estate was on a calendar year, is that they could have finished up in the year 2016, and when they were ready to make distributions, just make the distributions all in 2017, the first week in any estate, and the D&I would have already been taxed to the estate, and she would not have had to bear in her mind a disproportionate disproportionate tax, because when the distribution was made in 2017 of these amounts, and had there been no D&I, because it was the first week of January, and the estate was being closed, it would pull out there would be no income in the estate. So the court says, look, you could have worked around this. Does everyone get that? Am I talking, Disa, you got that? Sure. Do you see how you can play with the timing of these things? That If you want, you can let it stay in the entity, whether it be the trust or the estate, let it be taxed. And in a short year, when you're terminating the estate or trust, when there's very little income, make a distribution then, and the vast majority of that will fall under 102A, right? Non-taxable.
Excess of DNI at the time, right?
Excess of DNI,
Right, okay.
right? Rashida, you got that? So, I mean, look, these cases do not come up routinely anymore because right now, if you heard about this, well, one other thing I want to call to your attention. The dissent here. Usually, if you're like me, depending on your timing, you might not even read a dissent. But the dissenting judge, Skelton, is a fairly well-known, bright guy, and said, gee, this isn't really fair for the taxpayer. And there should be this concept. There's a concept which we're going to see later in the semester called separate share rule under Code Section 6666. Not 66, I'm the devil, listen to me. 663C, 663C, separate share rule. That at the time, it did not extend to estates. This at the time did not extend to estates. The law was changed in 1997, about 20 years ago, to follow the dissent here and say that estates too should have separate shares. And under the separate share rule, since the wife was truly entitled to only one half of the estate, and the children here were entitled, albeit they were going to have to bear the burden of the tax here, one half of the estate, that essentially the wife would have only, I want to just call to your attention that legislatively, this case was overturned by Congress vis-a-vis Code Section 663C, which says that estates can now be treated as a separate share if, in this case, one half is going to the spouse, the other half to children. In that case, only one half of the income on this distribution would be allocable to the spouse. The other half would be allocable to the children. We're going to study separate share rules later in the semester. Your takeaway for the moment, and why do the authors have it right here, is just to emphasize the one takeaway for our purposes right now is that the larger the distribution, the more the D&I, and the converse is true. The smaller the distribution, the less D&I it will pull out. Is everyone okay with that simple axiom? There's some more stuff like this in the notes. A more recent case that the Getty case, but I think we should move on to D&I. Now, you should also keep your code open to Code Section 643. All right, D9, 643A. The term D9 means, with respect to any taxable year, the taxable income of the trust or estate computed with the following modifications. So our starting point is taxable income. Agreed? Then we have to modify it. No deduction shall be taken. This would be circular if you would take a deduction for the distribution. So we're not going to create a circular There's no deduction for distributions when you're computing D&I. There's no deduction for personal exemption. Generally, gains from the sale or exchange of capital assets shall be excluded to the extent such gains are allocable to trust and or paid creditor or not, emphasis on the word not, I should say. Paid creditor required to be distributed to any beneficiary. Excuse me, or B, paid permanently set aside or used for purposes specified in section 642C, which has to do with charitable distribution, right? And then it's pointed out, losses on the sale or exchange of capital assets shall be excluded as well. Okay. Extraordinary dividends and tax stock dividends shall be excluded. Okay. And finally, an emphasis: tax-exempt income is included. Tax-exempt income is included in D&I. Reduced by any amounts that would be deductible in respect of disbursements allocable to such interest, but for the provisions of 265. So we have an adjusted, not all tax-exempt income, only that tax-exempt income after allocable expenses are allocated to it, okay? So that's 643A. And then there's a definition of D&I, but by way of contrast, look at 643B. For the purpose of this part and subparts B, C, and D, the term income, when not preceded by the word taxable, D&I, or undistributable net income or gross, means the income of the trustee or estates taxable year determined in the terms of the governing instrument or applicable state law. What is this cross-referencing for our purposes, for the purposes of the course?
Fiduciary accounting income.
Fiduciary accounting income, right? Everyone agree? That's the stuff at the back of the book, right? In the appendix. That's the fiduciary accounting income. So there you have two different contrasts. Now, just in case you haven't, but you should, look at the regulations and the examples. Let me highlight one or two. So, under 643. So, if you want to turn to 643 A-3, entitled Capital Gains and Losses. 643A-3. E. 643A-3E. There is several examples here, 14 to be exact. And just to call your attention, regarding these 14 examples, that if you remember, one of the items I distributed just highlighted, or just in one sentence said whether or not in each of these 14 examples, capital gains would or would not be included in D&I. Right? So this is something I distributed a week or two ago. And what you'll notice is, in many of these, D&I includes capital gains. In many of these, D&I includes capital gains. Now, you might say, strange, why would the government do that? Have so many examples where D&I includes capital gains. Fair statement. They do it because they just want to point out the exceptions. So your takeaway for tonight, again, let me emphasize, most times D&I does not include capital gains, but there will be. I don't want you to leave here or in your practice and think, oh, gee, D&I never includes capital gains. And even the predominance of the regulations says it includes it. So look at example 1, if everyone could, just to make sure everyone's got this down. Under the terms of the trust governing instrument, all income is to be paid to A for life. Okay, everyone got the visual. Trustee is to give in discretionary powers to obey principle for A's benefit and to deem necessary and deem discretionary distributions to be made from capital gains realized during the year. Right, so picture if you will, everyone do a little role play here. Pretend you're A, and you have a right to income, and the trustee can make discretionary distributions to you. The question is, if the trustee does do discretionary distributions, will the capital gain income be part of D&I? During the trust's first taxable year, the trust has $5,000 in dividend and $10,000 capital gains from the sale of securities. Pursuant to the terms of the governing instrument and applicable law, trustee allocates $10,000 in capital gain to principal. During the year, the trustee distributes to A $5,000 representing A's right to income, right? That's fiduciary accounting income. In addition, the trustee distributes $12,000 pursuant to the discretionary power to distribute principal. So notice, you guys, how much do you have in your back pocket? 17,000. Agreed? Everyone agree? You have 17,000.
Yes, sir.
And the trust has, remember, total income of 5,000 and 10,000 in capital gain. So the question is, you got 17,000. Will you be taxed on 5,000 or 15,000 or 17,000, right? That's the issue. Trustee does not exercise discretionary power to deem the discretionary distribution of principal as being paid from capital gains realized during the year. I have that sentence highlighted. Therefore, the capital gains realized during the year are not included in D&I, and the $10,000 in capital gain is taxed to the trust. Notice, Tina, is it a simple or complex trust? It is. I was just trying to see if you could fall into a trap. It's a complex trust, right, Tina? Everyone agree? Not only income is paid, but principal, discretionary principal distributions. Agreed? Mm-hmm. Right. So, therefore, the capital gains realized during the year are not included in D&I, and therefore the $10,000 is taxed to the trust. In future years, trustee must treat all discretionary distributions as being, as not, emphasis on the word not, being made from any realized capital gains. So once you do something, and we'll see this in these regulations, you're pretty much bound by it. Okay, once you start a pattern, if you're consistent, if you start something, the only way it's going to work is if you consistently do it. You can't just go back and forth in a way that you think is going to suit to minimize tax. Let's put it that way. I just called your attention 643-3B is entitled Capital Gains Included in D&I. Everyone see that? Capital gains included in D&I. When does that happen? The regulations give 3 situations when that happens. Situation 1, allocated to income. Okay? Is allocated to income, it's going to be consistently. If you consistently allocate capital gains to income, it's going to be treated as such. Is allocated to corpus, item 2, exception 2, or item 2, I should say. Allocated to corpus, but treated consistently by the fiduciary in the books and records and tax returns as part of a distribution to beneficiary. That too, D&I will include capital gains. And finally, allocated to corpus, but actually distributed to the beneficiary. So in the last year, for example, if it's paid out to the beneficiary, then let me give you a simple example. A trust has $1 million. It sells securities that are worth $1 million, have a basis of $100,000. So the capital gain is $900,000. Okay, everybody have that? So you have a trust with $1 million worth of cash, Google stock, with a basis of 100,000 worth $1 million, and the trust terminates. Well, the trust is going to have 900,000 in capital gain. Agreed? It's going to make a $2 million distribution. Who is the better party to tax if you're U.S. Congress? Is it the trust beneficiary or is it the trust itself? Well, you
Now or then?
after the distribution.
Then, like 2016 or?
After the distribution has been made, say the distribution is made in 2016. Who should be taxed on that $900,000 capital gain?
If you're Congress, you want the trust to pay it.
If you're Congress, you don't want the trust. Why, Dill? It doesn't have a dime. It lacks liquidity. So, right? If it makes a complete distribution, there ain't a penny left. So where should the tax onus fall? Well, D&I will include capital gains, and therefore the D&I will be pushed out to the beneficiary. Light bulb on?
Got it.
Rashida, did you see that? The trust started with $1 million in cash plus Google stock with a basis of 100,000, fair market value of $1 million. Trustee sells it, $900,000 capital gain. It's reported on the 1041, but it makes a final distribution that same year to the beneficiary, right? D&I will include capital gains in that case because who's holding the capital gains? We know that it's actually being distributed out to the beneficiary, right? Lisa, you got that? Right, so in that case, everyone see, now I am encouraging you, but for exam purposes, I can't be that creative. Look at these 14 examples. Do yourself a favor. There's not too many permutations for them. They're all pretty self-explanatory. I have highlighted, and this dovetails with what I'm just saying. Look at example 7. Under the terms of the governing instrument, all trust income is to be paid to A during the trust term. When A reaches 35, the trust is to terminate, and all principal is to be distributed to A. Because all the assets of the trust, including capital gain, will because all the assets of the trust, including the capital gains, will actually be distributed to the beneficiary at the termination of the trust, all capital gains realized in the year of termination are included in D&I. And then it cites you to the regulation that we just looked at. So do you see that's just hopefully affirming in your mind what's going on. But please, read the 14 examples, guys. They're not hard. And if you do, it will pay you back. Because if you don't know D&I, you cannot say you really know subchapter J. And if you can, and if you're perplexed at the beginning of next class, say, well, example 11 doesn't sit well with me because whatever. Whatever the example is, and let's go through it. Maybe there's some, piece of knowledge there that you're not familiar with, all right? But you got to know D&I. And yes, it'd be nice to always think to yourself, D&I never includes capital gains, right? But you'd be doing yourself a real disservice. Yeah, you would get it right most of the time, but as we know in practice, guys, getting it right most of the time doesn't cut it, okay? Don't tell your malpractice carrier you're trying to get it right most of the time. They're not going to insure you, believe me, all right? All right, I have a mental choice here, and I'm not sure how I should handle my mental choice. I think I'm going to try something a little different, which is I think will work for your sake and my sake. I'm going to distribute this handout. I told you, class 4, that we're going to try to focus on some real trust and estates, because if you keep looking at this book and all you read are cases, your head will spin, because you're like, where does this come out in practice, right? And some of you, your head is really spinning at this point because there's just these dense terms of art. Is that a fair statement, or no one's going to admit to me that you know these cases, they're hard cases to read, right? You only very dense. Is that a fair statement? Okay. Patrick's saying yes. David, dense. Okay. But the good news for your team is that here's one more. Is that can I leave you guys in charge for Muhammad and CJ? So can you take 3? One for you and 2 for Muhammad and CJ. That would be great. I have 6 problems here that for years I've been using, but I think they serve well. And usually I go through more of the textbook, and then I go through these problems. But I hope, by taking a little bit of a detour and going through one simple tax return, it will help you in droves when we start going through some of these cases, okay? So at least in theory, that's my psychology. So we're going to look at some 1041s. Are you guys excited? All right, that's what I want to hear. So what I figure we do is start with a simple trust with no capital gains. That's the only one we're going to look at tonight, guys. Simple trust with no capital gains. I think it's example 3. Okay? Do we need one more here?
Yeah.
Okay. I'm going to give you 3, and then I'm going to give Patrick 1 a direct one. All right? And we'll go, and guys, for exam purposes, I'm not going to ask anyone to complete a tax return. All right, so that's not my objective. My objective is, in going through this, is to bring home these points. That notwithstanding some of the obtuseness of the cases, that when you see it on paper, and you see how this is actually done, hopefully your head will not be spinning as much, okay? We'll see if I achieve my objective, okay? You ready? Feel like we're on a race. Let's do, I meant problem 2, okay? So we have interest and dividends, tax exempt, and no capital gains, okay? Everyone see that? Problem 2. Everyone have it open? Anthony, you got that? So you see we have taxable interest of 15, tax exempt of 10, dividends 25, rental income of 55. You got it? Total 105. Got some expenses, direct and indirect. Direct expense of 20, fiduciary fees and professional fees. Okay? Rental expenses allocable to rental income. We got to take care of, remember, you have tax exempt income, right, guys? What about our $12,000 worth of fees, right? The fiduciary fees and the professional fees. Will all those be deductible? No, right, Thesa? No. Now, if you haven't looked, don't for a moment. You try to pull out, just given what we know from the manufacturer's Hanover case, what would be the numerator and denominator here in terms of figuring out what would be the disallowance here? What would be the disallowance?
The numerator's 10,000.
The numerator is 10,000, right? And the denominator?
105.
Hmm?
105.
Is it 105?
I think it's 85.
Don't we just include alt all taxable income, gross income. Look at the example problem 2. Now, the way this was done, at least by the computer, was it did not include tax exempt. Does everyone have, by the way, could everyone see it's double-sided, right? So everyone saw? Well, listen, I'm drawing a blank. I have to check. I think it should be, probably should have to be reallocated to be 105 and not 95. It should include all income, right? The denominator here should probably include all income instead of just gross income, right? Everyone agree?
Yes.
For argument's sake, or else it's going to be really hard to follow this, just use the numbers they have here. Okay, the 1 million, the 1,000, the disallowance of 10.53%. Notice in the denominator, we do not have to worry about capital gains, right? Everyone agree? Because there are no capital gains, so we don't have to exclude it. So, let's go through, and I just want to follow you guys to follow. It's a simple trust, which means, Tina, what? What does a simple trust mean, Brett?
Distributes income only, no
It's
principal.
going to distribute only income, right, Tina? And what are the operative code sections? Lisa? 651, 652, right? Right, everyone agree? All right. So, what's going to happen here is that let's just get different categories that well, I think I Xeroxed this up, so you should have my little chart here. So remember, guys, we have the indirect expenses, right, that we have to allocate, the allowable indirect expenses. And there's going to total $12,000, right? Everyone agree? So if you see my little chart here, I have taxable income, tax exempt, dividends, rental income. So take each one and we have the trustee and accounting fees, fiduciary fees. So remember, and then you see the real estate expenses. Notice how the real estate expenses have to be allocable directly to the real estate. That's a direct expense. So that expense goes directly under rental income. The other expenditures, right? The allowable expenditures for the accounting fees and the fiduciary fees are designated to be $10,736, right? Where did that number come from? Where did that $10,736 come from? That's $12,000, right? Those are the total fees. Everyone agree?
Yep.
And the amount that's disallowed, 1,264. So that allows 10,736, right?
Professor, did you retype this at some point? Because the packet with the tax returns has rental income of 45, and the first one you gave out is 55. That's a $10,000 difference.
Where do you see 55?
This has 55 here. That's why this is 105 versus this 95.
You know what? That's probably what happened. Okay. That's what happened. The rental income, okay, I see. Thank you. Yeah, I think I got, okay. The rental income should be 45, not 105. Did everyone see the sample problem? Everyone see the sample problem? Instead of having it at 55, make it 45. And all bad things will go away. Thank you.
That's
Jenny,
what I
you see
got,
that?
105. I got 105 from this.
Yep. Okay, but that should be 95
Yeah.
once you change it. And then it'll all fall into place. Rashida, do you see that? Okay. So once you make that change, now let me just point out to you my beautiful handwriting. We know that the $1,264 has to be allocated to tax exempt. Everyone agree?
Yes.
Okay. But here, the remaining numbers, the computer just allocates proportionally based on the size. So with taxable income is $15,000 at a 65, dividend income is $25,000, rental income is $25,000. Total taxable income is $65, and just took those expenses and allocated it pro rata. Okay, so that's this column here. If you ask, where did I come up with the expenses? Or how did the computer back into those numbers? Anthony, you see that, or is your head spinning? I just took the indirect expenses and allocated them based on the size of the income.
Oh, that's what the 65 comes from. Okay.
Okay?
So pull the rental expenses out first before you allocate the rest of it.
Yeah.
Got it.
Okay? Now, all right, so let's just, the first part, Patrick, right, was a reflection of chapter 2, right? This whole thing about how do we allocate expenses, the indirect expenses, and take into account Code Section 212, the indirect expenses, and allocate it to tax exempt income, right? And that's the first part of the problem. And then the other part of the expenses just allocate, there's a lot more flexibility, by the way. The computer, if you don't instruct it, will just allocate the expenses pro rata. But you can, with respect to indirect expenses, other than that allocable to tax exempt income, you have the liberty to allocate it to whatever you want. So you probably, and we'll see this, want to not allocate it to dividend income, right? Because dividends have preferential rates. Agreed? So you could take that 4129 and you can allocate it to rental income or taxable interest income, because those are taxable at the highest rates, right? So you've got to be careful what your computer does. All right. For the moment, we'll get back to it. Let me just make some more observations. If you can't tell, I'm very excited that you guys finally have a 1041 in front of you, okay? Because I know, and you know, the material, the first 2 chapters, including this part of chapter 3, is intense. And you're like, okay, but where do we go with this? Here's where you're going with it. So, first of all, right, notice it says the type of trust, and hopefully on the very top left. And everyone in this room can put a designation. Is it an estate? Well, you guys know. Did someone die? Well, that answers that question. Is it a simple trust, complex trust? And then we'll be looking at chapter 4. Is it a grantor trust, right? Everyone see? We're going to try to cover many of these, not all of them. Okay? Is it an initial return? We'll check that off, right? Now look at income, okay? Interest income. We have to include dividends, qualified dividends, Rents, 25,000. So total income, 65,000. Everyone see that? Right. So everyone from your income tax course could handle that part, right? No one would have a challenge there, right? Now, deductions. The fiduciary fees. Notice line 12. Is it a full $10,000? No, right? That portion which is allocable to the tax exempt is not deductible. Agreed? Same thing goes with the accounting fees, right? Not $2,000. We're going to lose about 10% of that, right? A little more. Okay, so those are deductible fees. Now, you take the difference, and that becomes line 17. That's your adjusted total income. Right? That's your taxable income, right? $54,264, right? Everyone got that? That's the income, taxable income, before any distribution deduction is made. Agreed? Stop me if you don't see that. Adrian, what becomes extraordinarily exciting in my world is that line 18 is entitled IDD. Well, not really, it's called, but it's called the acronym IDD. Income distribution deduction, right? And that's what differentiates all of subchapter J from everything else in the code. This IDD, right? How do we figure out the income distribution deduction? Notice, it's not D&I. Everyone see that? You don't get a deduction for D&I. You might think so if you never looked at the tax return, but that's not the phraseology. Well, very exciting again. If you turn the page, drum roll. Because we are going to get to Schedule B and IDD. Everyone see that? What's our starting point? It's what IDD starts with, is the total or the adjusted taxable income from the prior page. And the goal line, right, Adrian, is to get to D&I. We need to figure it out. Schedule B, notwithstanding its title, along the way we had to figure out D&I. What do we do first? You guys remember D&I must include the tax exempt income, right? Must include it. Notice, not including all of it, it's adjusted for the allocable expenses, right? Our Schedule B will become more complex, but for the moment, relish in the simplicity for the moment. And notice, we do not have to add back in the personal exemption. Why? Because the adjusted total income from the prior page never took into account the personal exemption. So don't worry, it's not flawed. If you look on the prior page, page 1 of the 1041, if you look at line 20 under deductions, we never got there. So the people who create these forms are geniuses. Okay, forget about sending a person to the moon. The people who create these forms, really smart, right? They said, you know what? Let's pick out a number before we get to the exemption, then we never have to add it back, right? Everyone agree? So don't think it, when you look at 643, the definition of D&I, you might think to yourself, right, that, well, I'll look for the tax exempt, I gotta add back the personal exemption. You ain't gonna add it back, it was never in there, right? Everyone agree?
Sorry.
right? Everyone see, it's in bold. You know, whoever created this form said, gee, such an important term. We're going to put it in bold, right? Not too many forms put things in bold, right, guys? So it must be important. And there it is, line 7. D and I. Got it? But notice that is certainly not the final leg of the journey, because remember, that's not even the number used on the front page of the return. So we take D and I, okay, we compute what it is, we take it, and we look at the total distributions here, okay? How much were the total distributions here? Say again? Well, we had 95,000 of income, and we had $32,000 worth of expenses. No. So it's 63, right? This is the fiduciary accounting income. That's how much the beneficiary can demand, and we'll get. And then remember, even though we added it to D&I, in terms of figuring out the income distribution deduction, we have to take it out of D&I, right? So it's going to get subtracted. You might say, why did they add it in to D&I to only subtract it, right? You might say that. Anyone saying that? And you'd be right. Like, why do that? It seems like such a worthless exercise. Agreed? The exercise is why? Because there's a code section 652 and a code section 662, meaning when you include an income D&I, you have to know what's tax exempt and what isn't, right? So only by having the full D&I and knowing what that number is, can you figure out what the tax exempt income that is embedded in that you will have to report. You have to report it sometimes for state, for state purposes and things like that. So
Right.
the government wants to know what is the tax exempt income. But the distribution deduction itself, the IBD, is 54,264. Look back on the first page and notice, right, Adrian? That's key. Line 18, because we're going to get a distribution deduction of that. Now we're going to get the exemption, and we're going to be left with negative $300 of income. Not surprising, right? Simple trust for 18 with no capital gains, and therefore it will not have to pay a tax. How does the beneficiary know what kind of income? Look at the K1. Turn a few more pages. You have Schedule E, which has the rental income. Then you have the K1. Now, on the K1, I just want to call your attention, line 9 of the K1. Who gets the depreciation deduction here?
Beneficiary.
The beneficiary. Notice why? There is no reserve here, right? Everyone see that? No reserve? The beneficiary gets the entirety of the depreciation deduction. And I just call it, I'm sorry about my handwriting, but depending on how you want the remaining expenses, remember, with tax exempt, why do we have to include in D&I the tax exempt? because it's got to be reported. Okay, it's got to be reported to the beneficiary, line 14. And then with respect to dividends, they're taxable at preferential capital gains rate, so you probably don't want to allocate any of your expenses to it. Okay, don't want to allocate any of your rental expense. Excuse me, I'm thinking rental expenses, but if you look to the bottom right, you can play games with the indirect expenses and how you're going to allocate them. And apparently, that's what was done in this problem too. The expenses were not allocated. They could have been allocated to the dividends, but instead they were allocable to the interest income and the real estate income. Okay? And there you have a K1. All right. So, here is a simple example of a Form 1041 that reflects in our world, Chapter 2, this our textbook. It shows just simply how to reflect income, how to take depreciation deductions, and it's the starting point for us to think about D&I, and now I think it makes it easier, I hope it does, about looking at some of these cases and seeing what the implications are for 1041. So you guys have to become, again, I'm not going to, on an exam, you're not going to have to fill out any tax return, but will I ask you to compute D&I? Sure. And I'm going to go through several examples on the board of computing D&I in a way that would be, I'll say, what I would look for in the exam. But forget about my simplified version. Here it is, Schedule B. That's how it comes. That's it. So if you can, and we're going to go through, you can see 5 more examples like this. But I want to do more in our textbook and go through more examples in our textbook. And then with that knowledge, I think it'll be even easier to look at the 1041s. All right? So I thought we could just pause, take our 15, look for 15 minutes of this. I think that will help orient us for some of the denser cases, and then we'll come back to this. Not necessarily tonight, but over the next 2 or 3 classes, we'll look at simple trust with capital gains, we'll look at complex trust, we'll look at estates. And this way, this hopefully will not be as foreign. And you can see, notwithstanding the density of the cases, on the return itself, this is what people are paying you money for. It will not be foreign to you, okay? And if you look through this on your own and you get stuck with allocations or where the numbers come from, you can easily get lost. Just let me know, okay? But we're going to return to this, okay? We're going to return to this. All right. So we're going to look at a few cases, and we're going to go through a few of the author's problems, and I'm going to say we're going to have some fun, but you'll be the judge of that one. Just get my quarter back here. Right. So, Baker case. D&I includes capital gains. In Baker, does D&I include capital gains? Okay. In Baker. Here, the trustee claims, well, first of all, there is a complex trust here. Let's just get that out there. And the issue regarding this complex trust is whether the taxpayer, the beneficiary, is entitled to a deduction for certain partnership losses allocated to him by the trust. Right? Is the beneficiary allocated, allowed those losses? And here, this is not the controversial part, that here, capital gains were included in D&I. Capital gains were included in D&I. You see on page 123, there is interest, dividends, capital gains. And the trust was allocated certain losses from a partnership. Okay? And subsequently, these losses were disallowed. This partnership was deemed to be a tax shelter, and the losses were disallowed. So, the question is, this is pointed out on page 124, that the losses were disallowed. This is in the second full paragraph. And what it points out, in the second full paragraph, in the second or third line of that second full paragraph, in the statutory notice of deficiency, respondent, which is the IRS, stated the excess of $1,717.79 was petitioner's quote-unquote proper distributed share of loss from the trust. IRS did not disallow petitioner's deduction of that amount, quote-unquote allocated partnership loss. So, of the original, let me simplify the numbers here. Of the original $7,000 of partnership losses, only $5,000 was disallowed, $2,000 was allowed. Okay? Which the partner, the IRS is saying, floats down to the beneficiary. Now, let me make an observation that you guys should make sure you understand. Is a partnership, is a trust, is an estate, which is what we're studying, right? Subchapter J. Is a trust, is an estate, a flow-through entity, Jenny? Yes or no? Yes? Sal, you agree?
Yes.
It's why do you think so? Easy. Flow-through entity, conduit entity. Patrick?
Listen, if you compare it to a partnership, which is also a floating entity, the income or losses distributed to the partnership.
Not always, but it doesn't matter.
It's
Let's put it this
similar-
way. In a partnership, in a subchapter S corporation, income is earned, and whether or not it's distributed, right, it's allocated to the beneficiaries. Agreed?
Right.
So if a partnership has two people, partnership makes $100,000, each one's got to pick up $50,000, whether or not a distribution is made. And if distributions are made, Code Section 731, they're not even taxable, right? It's not the distribution that's taxable, it's the earning, right? Agreed? Is the same true, Jenny, Sal, Lisa, with respect to a trust or an estate? Is the beneficiary taxed if the monies are not distributed? If the money is earned, whether or not it's distributed, are they taxed? David? Are beneficiaries taxed on a trust and estate if the money is not distributed? No. Is it a conduit entity? No. Right, Jenny, it's predicated on the fact that you'll get a K-1 with income if it's distributed, but if it's not distributed, you're not taxed, right? So it does not have the same features of a partnership or S corporation, right? Agreed? So Jenny, can you ever get the losses that a trust or an estate endures? Can you get the losses on your tax return?
On my tax return?
If you're the beneficiary.
from the trust? Why
If the
not?
trust is, I'm sorry?
Why not?
I'm asking you, can you?
Yeah.
You can. Sal?
I think you can.
Can't? Lisa?
Can't.
David?
You can.
You can. Adrian, who's right? You can, you say. When, Adrian? All the time, some of the time?
Some of the time.
And when is that some of the time?
Not sure.
Anthony?
Not sure.
Brett, you want to chime in?
Honestly, I lost track of what the question here was.
Can the trust beneficiary ever get a loss as a result of being a beneficiary when the estate or trust has a loss?
Not directly, right? Just as a result of what they ultimately are distributed to, but not directly.
So if the trust suffers $100,000 losses in 2016, can that be passed through vis-a-vis K1?
No.
No?
I don't think
No?
so. It should adjust the DNI.
It will adjust the DNI, but can the loss itself ever be passed through? And the answer is no, with Adrian, one caveat. Code section 642H, the year of termination. The year the enterprise, trust or estate ends, and we'll see this soon, the beneficiaries can get the losses that have been carried forward or the losses that year. But any other time during the administration of the estate or during the tenure of the trust, Jenny, there are no losses that pass through. It's not a flow-through entity. All right, so if some beneficiary is relishing, like, oh, I'm a beneficiary of a trust and I'm going to have a lot of losses pass through to me, I have a great tax shelter, probably not unless it's the last year. Right?
Can you carry forward the losses to future?
You can, if it's not under code section 172 as an NOL. If, assuming it is truly, now a personal exemption like we just looked at in problem 2 is not an NOL, so that loss disappears, right? It's gotta be.
You mean it's for all trusts or only for the simple complex trust?
Are there any other kinds, Jenny? Did you just answer your own question? There are no other kinds, unless you know something I don't. All right? But this is an important conceptual point. And does it make you feel better that in this case, apparently the IRS blew it? I mean, the IRS is the one arguing, well, $7,000 in losses, $5,000 disallowed, the other $2,000 the taxpayer can have on his personal return. So if you're feeling a little awkward, you're a good company, right? The IRS blew it here. So the disallowance of the loss, what effect does that have? You guys just looked. What effect would a disallowed loss mean? And I think one of you mentioned it before.
Well, at the trust level or?
Well, it was disallowed at the trust level.
Okay.
So the corresponding effect is D&I will go up, right? Because taxable income will go up. And if taxable income, the starting point on Schedule B, right, Lisa, is the taxable income. So that means that the taxable income on Schedule B goes up and D&I goes up.
With the distribution deduction.
Well, the distribution deduction will go up, but also the beneficiary will have
Beneficiary gets
more income. And notice, no matter what will be the taxable income of this trust? Probably 0, right? Do you recall in Manufacturers Hanover and several of the other cases in Chapter 2, they talked about the outcome being, the phraseology was static, meaning there was no difference in outcome to the trust, right? Because no matter what, it had 0 income, static. But the beneficiary, as a result of this disallowance, D&I will go up. As a result of D&I go up, the taxpayer will have more income reported on the Form K1.
Not to
Yeah.
jump back a bit, but those losses that on termination, is it just a reduction of like a principal distribution, or are they separate losses that the taxpayer can pay?
Say that slowly, Joe.
The losses that come through on termination,
Right.
the carry forward losses, are they like separately stated on the K1, or is it just a reduction of like a principal distribution out?
No, you're gonna see it's gonna be separately
Okay.
reported. So, what ends up happening here, the authors of this opinion talk about the fact, and it's worth reading, obviously, guys. It will highlight, I think, I hope, that losses are not distributable. So it's a good read to just reinforce that point. If they were allowable, and this is important, Jenny, if they were allowable, it would, those losses that were on the taxpayer's return would actually serve as a double deduction, right? Because the losses would reduce D&I, reduce his taxable income, and then somehow if the losses ended up on the taxpayer's return, they'd be offsetting, creating another loss. So the losses would be reducing income in two different ways, so that's not allowed. Now, the authors in this opinion talk about the fact why capital gains were allocable to D&I. That's not the issue, that this case really examines, but that's okay. If you look at footnote 6, it explains why. And then at the bottom of page 129, footnote 8, even though it's a little bit of a pain to read because it's on 2 different pages, it talks about each class of income. Interest, dividends, excluded dividends, capital gain, total income. Then if you turn the page, they allocate different expenses. And here there's no tax exempt income. And they just show what would be output. So what's your takeaway from the Baker case? Just an illustration, and you can read why capital gains can be, sometimes is allocable to capital gain. D&I will sometimes include capital gains. We saw that in the regulations in the 14 different examples. So that's one takeaway. And then the second takeaway is how to handle the partnership losses. One more case and then we'll take a break. How's that? One more case. The Schiefer case on page 130, we just get an excerpt. What controls? Federal or state law determining what goes into D&I?
Federal.
Federal law, right? And that's spelled out on page 130, the second full paragraph. Like 7 or 8 lines down in the second full paragraph on page 130, it says, even if petitioner's argument under the state law is correct, it's irrelevant. State law creates legal interests and rights, but the federal revenue law designates what legal interests or rights so created will be taxed. So it's a non-issue if partnership income, for whatever reason, is excluded from income under state law. it has to be included for purposes of D&I. Just not surprising, guys. There's a famous U.S. Supreme Court case called Bosch v. Commissioner. And in the Bosch case, the Supreme Court affirms that federal law will always control. Okay? You can't have 50 different states dictating what the outcome should be, motivating taxpayers to move to a more favorable tax jurisdiction. Right. So here's the agenda, guys, for what we're going to do after break. The authors are going to give us several more examples of when D&I will or will not include capital gains. And we're going to go through some more numerical examples, getting closer to what I'll call exam-like questions. So hopefully by the time tonight is over, you'll be feeling more comfortable looking at both the cases and some of the numbers. But you did get your first example of the 1041. You're still breathing, I hope. So why don't we take our 8 or 9 minute break, come back and pick up where we left off here, okay? So, like I said, originally we had the Baker case standing for when it includes D&I because the trust terms, the terms of the trust actually permitted the D&I to be included. We know the federal law controls. What about this Chris case? And here we have a trust established by the Hunts, and 1% is invested in a limited partnership, okay? 1% is invested in a limited partnership which is engaged in arbitrage transactions. So everyone have the visual? We have a trust, and part of its investment portfolios includes a partnership. So we have a trust here, invest in a partnership, and the partnership invests in arbitrage transactions. Okay. What are the terms of the trust? The trust is authorized the trustees to make discretionary payments to Carolyn Hunt, and 21 years after her death, it passes to her descendants. Just to remind ourselves, Anthony, what rules?
The rule against perpetuities.
Okay, everyone got that? Rule against perpetuities, right? Remember? That rule has been vibrant in many of the cases we've looked at. That's where, if you read these cases, if you're wondering, again, the rule against perpetuity says essentially property must vest within 21 years of a life in being. Okay. During the 2 years in question, the trust distributed $4.5 million and $1.6 million. I guess I wouldn't mind being Carolyn Hunt, right? And took an IDD deduction, income distribution deduction, right? And for purposes of computing D&I, the trust included short-term capital gains distributed by the limited partnership. The service said the gains were not includable in D&I. They were not includable in D&I. Okay, and thus, they're not includable in D&I. That means who gets taxed on them?
The trust.
The trust, right? Everyone agree? The taxpayer took the position the capital gains were included. The IRS says not included, and by extension, if the IRS says not included, that means the trust income is taxable to the trust. Okay. Remember, capital gains generally are not, so the taxpayer are the onus here, right? And generally, capital gains, we say capital gains are part of D&I because generally capital gains are not distributed. Why? Because the people who set up the trust, her parents, Carolyn's parents, by not distributing the capital gains, what's most likely to happen with respect to the remainder beneficiaries? Are they going to become richer or not so rich? If you include capital gains in D&I and make it distributable, will the remainder beneficiary be financially better off or worse off? Everyone understand the question?
Worse off.
Worse off, right? Because by including capital gains as part of income, there's going to be less, right? When Carolyn dies, there's going to be less there because she got more of it, right? Now, when the parents set up this trust, do you think they were looking or had like foresight to think about their grandchildren, right? This is their grandchildren. Is it that whom they had in mind when they set up this trust? The answer is no, right? Why? At what age did they set up this trust for Carolyn's benefit? You recall?
12.
Yeah, she was age 12, right? Very young. They didn't, unless she was a very precocious child, she did not have children at that point, right? So the parents presumably weren't, that was not the foremost thought on their mind, their grandchildren at the time they set up this trust for 12-year-old Carolyn, right? And you can look to two places generally to see if capital gains should be included in trust income. Place number one, the governing instrument. The governing instrument can say, treat the capital gains as part of income, right? Could say that. Where's the second place you could look? Here you can look under state law, right? Because state law will dictate the rights. It won't dictate the taxable income, right? The tax consequences, but it would dictate the rights. State law can dictate what constitutes income and what doesn't. It doesn't dictate what are the tax outcomes, right? Okay? Now, here, remember, the trust was getting these from the partnership, short-term capital gains. Now, let me make one observation. The court makes the observation. Remember, we have a trust, partnership, and securities. Everyone have a visual? Three-tier layer cake. Trust, well, four-tier if you want to include the beneficiary here, because we have Carolyn, the beneficiary, we have this trust, we have a partnership, and we have it investing in this amorphous set of securities, right? All these different layers. If the trust invested directly in the securities, okay, there's no partnership. If the trust invested directly in the securities, and the securities were bought and sold, and there were capital gains, under the Principal and Income Act of that state and every state, would the capital gains be considered part of income? And the answer is no, right? Everyone agree? That had the trust directly invested in the securities, right, Patrick? They don't own Google stock, they don't own Facebook, they don't own IBM, and bought and sold those securities. Those capital gains would not be part of D&I. Agreed? Everyone agree? Mm-hmm. However, that was not the case. Here, the trust invested in a partnership And suppose, and the court offers one other observation. Suppose instead of a partnership, the trust had invested, this was a corporate entity, okay? Suppose this was a corporate entity, and the corporation invested in securities. And as a result, the corporation earned income, okay? Earned lots of income, right? As a result of investing in securities. And then the corporation paid dividends. Would anyone have a question? Would that be income or would that be principal?
Income.
Income, everyone agree? So, in this particular case, they say that under the Principal Income Act, limited partnership interests were not addressed, okay, under the principal income. And that being the case, the court decides that there's latitude to how to interpret Texas Principal Income Act law. And here, because the partnership had net profits as a result of investing in these securities, and yes, they were capital gain in nature, but they were part of the net, under this term net profits, it had a stronger aroma of being income. So it was able to take these capital gains that were part of the securities, and because they were in the form of a partnership, and because this resulted in net profits from the investments, those net profits, it's not a perfect answer. Okay, that's why this went, as far as it did. They deemed it be. Dale, you had a question or a statement?
I guess I wanted to clarify what you were saying. Essentially, that partnership was in the business of buying and selling investments and things. And
Yeah,
that's
it was
why.
an arbitrage partnership.
Right, and that as opposed to just random capital gains on the side it would have.
Even then, I just wonder rhetorically.
Okay, yeah.
I don't know what the answer would be. The court was willing to give a lot of grace here.
Okay.
Latitude, I should say. So, what you take away from the CRISP case is sometimes, as long as the trustee, I have to say, and this case was decided before the new regulations, which aren't so new anymore, where essentially, if you're consistent, in my opinion, and you consistently treated the capital gains, as income, guess what? I think this would never be a case in the year 2016. Everyone hear me? That if the trustee from inception makes a decision to treat, and the trustee obviously can't, when I say the trustee decides, the trustee doesn't want to do anything that will violate the terms of the trust, because if the trustee does or violates state law, the trustee risks being surcharged or being derelict. Who's going to sue the trustee? If I'm a remainder person and I take an aggressive position that seems far-fetched, the remainder beneficiaries potentially can sue me, right? So I'm going to assume that either the government instrument or state law gives the trustee enough latitude, and if the trustee consistently treats capital gains as income and distributes them out, then the government will permit it, and the D9 will include, right? The D9 will include capital gains, as long as you're consistent. And if you read those 14 examples, I think they support my position. Right, so that is the CRISP case. And if you're boggled down by the CRISP case, I can't tell I can't tell you with definitiveness because I don't have the examples under the regulations memorized, but I am sure that one of the examples, like example 4, where D9 includes capital gains, why? The governing instrument. Example 4 is the CRISP case probably in 2 sentences, okay? That's the whole takeaway. Do you see what I'm saying? That if you're a little bit numb from reading the CRISP case, I still think you should read it, but if you distill it down to its basics, just capital gains can be included in D9. Remember, if D&I includes capital gains, what happens when we do under manufacturer's Hanover, our numerator and denominator?
They also include a capital gain.
It will also include capital gains. You hear what I'm saying? Everyone should be writing that in their notes because I see in years past people make that mistake. Let me repeat. If D&I does include capital gains, then manufacturer's Hanover, the denominator will change, and it will include capital gains, right? Okay, we have a revenue ruling, 68-392. The question in this revenue ruling is, does D&I include capital gains? Here, the trustee has to pay $24 each year to the beneficiary. And the question is, the trustee had $10 of income, and had to be paid the beneficiary had to be paid another $14, and the beneficiary was paid securities, which had a fair market value of 14 and a basis of 12. Well, we all know, right? From the Keenan case, remember back from your income tax days, K-E-N-A-N, Keenan, that if you use an appreciated asset to satisfy a debt, it triggers a gain. And if you recall, that led to thousands of dollars of litigation. If you remember at the beginning of chapter 2, that was our Bingham case, is an offshoot of the Keenan case on page 33, but that's a story for a different day. All right, so back to revenue ruling 68-392, is that here we have a trustee who's trying to satisfy this $24 obligation, has $10 of cash, and has to use appreciated security, and we know he's going to have $2 worth of capital gain. And the question is, should the capital gain be included in D&I? On page 141, the second full paragraph, notice that the trustee generally did not include, again, all these are under the former regulations. What happens if every time the trustee utilized appreciated securities to satisfy this obligation, every time the trustee had insufficient income, every time the trustee recognized gain under Keenan, they consistently, from inception, treated that capital gain as income? Would that be considered part of D&I? And the answer is, under the new regulations, not the prior regulations, under the new regulations, yes. That if you're consistent, and every time you recognize a capital gain, you consistently treat it as income. Then it will be part of D&I. All right, so your takeaway for revenue ruling 68-392, and big letters in red I have written to the left, wrong. Why is it wrong? Because it reaches the opposite conclusion. Why does it reach the opposite conclusion? Because it is predated. It predates the new regulations, right? The new regulations override this revenue ruling. so everyone, for your notes, you know that revenue ruling 68-392 has been administratively overruled.
Professor,
Yes, sir.
just logically speaking, I know that's dangerous sometimes with the tax code, but if you're the trustee, and I'm the beneficiary, and you give me an appreciated asset to satisfy that gain, it's not like you have anything to keep. You've given me the asset, right? So
Okay, so I give you Google stock,
Right.
worth 14,000, basis 12,000, keep going.
I mean, it's not as if there's any real capital gain for you to keep. You haven't kept any of the.
I mean, but remember, all money is fungible, so I could have a lot more money in the trust.
Okay.
I'm not terminating the trust as a result of paying you.
Right. Okay.
That's true, could be often true with capital gain income. In other words, it can have a very strong aroma than a distributed principal as well.
Okay.
Patrick, you were going to say something?
No.
Okay. All right, so everyone got that? You're going to read the regulations, you're going to read the examples, you're going to, don't have to commit them to memory, but it will bear fruit if you do. And if you have questions, you can let me know. Page 142, we have a TAM, 87-28-001. And the question is, I have on top of this TAM, condition 1. You might say, what am I talking about, condition 1? Well, just turn back, if you have open your regulations. Look at your regulations, if you don't mind, 643-3. A-3 and -3B. Everyone have that? 643A-3B. Lisa, you got it?
Say it again,
643A-3B. I'll tell you the page number, but we all may have different ones. And it says capital gains included in distributable net income. And if you see, there's 3 numbers there, 3 times. And the first one is when it's allocated to income. So this technical advisor memorandum addresses that first condition. When is that first condition met? It's supposed to help illustrate. And if you look at the issues, it says whether capital gains are included in the computation of D&I when a trustee exercises his discretionary power under the trust instrument to allocate receipts from the sale of trust principal to income. Okay, so the question is this first condition met? And if you read the facts, the trust was funded with closely held corporate stock, which was sold in 1983. I should back up. The grantor here established an inter vivos trust. That means during life, not a death, not testamentary, for the benefit of his grandchildren, right? We put a name to that, right, Dow? It's a GST trust, right? Generation Skipping Transfer Trust. G transferred C stock, closely held C corporation. Trust agreement provides the trustee shall divide and administer the trust principal of the trust estate to 7 equal shares, 1 for each of the 7 grandchildren. If you look at the second paragraph on page 143, it says paragraph 4H of the trust agreement provides that the trustees have the power to determine the manner of ascertainment of income and principal and the apportionment of income and principal, and the apportionment between income and principal of all receipts and disbursements into selected annual accounting period. Oh, that's pretty broad, right? The trustee is given tremendous latitude, right? In the next paragraph, it says, the entire corpus of the trust consisting of the closely held business stock was sold. Trustee realized the gain. Of this amount, the trustees allocated X G dollars to income pursuant to the exercise of the discretionary authority. Trust received additional income paid in that year. And now it makes a distribution deduction. Are the capital gains part of D&I? So you look under law and rationale. On page 144, second full paragraph on page 144, I just want to call this to your attention. We're going to see it again. There's something called the 65-day rule, you're probably familiar with, that figuring out how much income a trust has or how much income an estate has is really challenging during the year itself. So it's only after the year passes can you really do it. So the code, grants some latitude here, 65 days, that after a trust or an estate year ends, that if it does, you can make a distribution within that 65 days and elect to relate back to the prior year. Just want to call that to your attention. It's called the 65-day rule. That's under 663B1. Code section 663B1. Then it launches into a discussion, and if you're having trouble following the prior revenue ruling, 68-392, in those two paragraphs, it summarizes the outcome of that revenue ruling on page 140. And remember that revenue ruling, contrary to current law, decides that none of those three conditions under the regulations were met. So remember, that revenue ruling, it decides that D&I does not include capital gains. On the page 144 at the very bottom, it distinguishes. It says, in this case, the trustee was granted discretionary authority to allocate all receipts between income and principal. Accordingly, the trustee did allocate the gain, the trust corpus, to income. This granted discretionary authority to the trustee under that paragraph of the trust is permissible. And therefore, two paragraphs later, it says, therefore, we conclude that the G dollars of gain from the sale was allocated to income by the trustee pursuant to the paragraph is included in the computation of D&I under Code Section 643A3. So condition 1 here was deemed to be met. So the takeaway for your notes, you have a technical advice and memorandum illustrating how this is met. We have a private letter ruling that follows. By the way, given the percentage of 1041s which are audited, it's anemic. And you know, income tax returns that are audited, what percentage of income tax returns generally are audited? About 1% these days. I think it's 0.1% of 1041s. So when you say, gee, why are these authors citing to private letter rulings? Can't they do better? Aren't there more cases on this? The answer is no. All right, so if you're wondering, you've been through a lot of tax courses and you're always reading Supreme Court cases, you're reading appeals court cases, you're reading all sorts of things, and rarely do you see private letter rulings elevated to the status of, well, that's because there's not a lot of things going on here. You have the IRS, they say tongue-in-cheek, like in Baker, saying, oh, losses can be distributed out. I mean, it's frightening. So just whatever it's worth. All right, so we have a private letter ruling. It is what it is. 8429,005. And here, we have to decide if the second condition was met. What's the second condition? It's spelled out, right? These are right in that regulation, right? You probably, I hope, have open. Allocated to trust corpus. It's allocated to trust corpus, but treated consistently by the fiduciary on the trust books and records and tax returns as part of the distribution to the beneficiary. Right? So that's condition number 2. All right. So what are the facts here? Here, an estate received an installment obligation from the decedent. The installment note had essentially no basis. And why did it have no basis? Because you might think, doesn't Code Section 1014 apply? This is what we'll learn later in the course. This is what we call IRD, income with respect to decedent, under Code Section 691. So items which constitute IRD under Code Section 691 do not get a basis equal to fair market value under 1014. All right, so in this case, what condition is being examined? Does condition 1 apply? This is spelled out on page 147. Okay, page 147, the second full paragraph. Condition 1 is not met. Last sentence of that paragraph. This requirement is not met in the present case since the governing instrument is silent as to capital gains and the law of New Jersey allocates such gains to corpus, okay? In contrast to the technical advice memorandum, where the governing instrument permitted a lot of latitude, here, there is no such latitude, okay? So condition 1 is not met. Condition 3, the next paragraph, that's the third paragraph down on page 147. If you look at the last sentence, because the terms of the instrument are silent on this point and the fiduciary had not established practice of utilizing capital gains in making distribution, this requirement is not met. So condition 3 is not met. If you look at the next paragraph of the regulations, provides that capital gains are included in D&I if they are allocated to corpus and actually distributed. In the present case, under the laws of, I'm saying New Jersey, the capital gains are allocated to corpus. Thus, to the extent the capital gains are actually distributed, they will be included in D&I of X. Right? So in this particular case, if they are actually distributed, you know what? This is, I guess they may have, under the old versus the new regulations, changed the ordering, because this is condition 3, where it's allocated to corpus. If you look at it numerically, it's allocated to corpus, but actually distributed, which is what's going on here. Everyone see that? That this is like a termination distribution. So this is allocated to corpus, but it is actually being distributed as such. It does constitute part of D&I. Everyone see that? So this is our, in the new regulations, I'll call them, it is the third condition, not the second condition. Right? What is the effect in revenue ruling 61-20? What is the effect of an NOL? What effect does an NOL have? Can it be, Jenny, can it be passed through? Ever?
Until termination.
And what's your authority for that? 642H. Right, so again, NOLs can't be passed through, okay? Harshita, does that mean they just disappear? What would you do if a client of yours trust had an NOL? What effect would it have? Yoni?
Can be part of the distribution.
Can't be part of the, it's a loss.
Right.
So what do you do if the trust has a $100,000 loss? What code section do you guys remember? It's not from your income tax days. You remember code section 172 deals with NOLs. And do you guys know from your own practice, how many years can you carry an NOL back?
2 years.
How many? 2 years forward, 20 years forward. 2 years back, 20 years forward. So Yoni, Rashita, you can carry back the NOL 2 years. What effect will that have? If the trust carries it back, assuming the trust has been around for a while, so it carries it back 2 years, what effect will it have?
DNI will be lowered.
DNI will be lower, and chances are, what will be the further rippling effect?
Distribution is lower, which is
Not necessarily the DNI, the distribution is probably the same because the money's already been distributed, but they can issue a new K1 because now, let's say that the person before was taxed on $150,000 and now the NOL goes back 2 years, it would reduce DNI from 150, say, down to 50. So you would reissue the K1, they could file an amended 1040, right? Everyone see how that, again, based on what you saw tonight, the NOL would reduce the taxable income. As a result of reducing the taxable income on Schedule B, it will reduce the first line on Schedule B by whatever the NOL is that's carried back. As a result, DNI will be less, the income distribution deduction will be less, that's okay, right? But the K1 will be reflective, right, of a smaller DNI. Again, the results of the trust or the estate may be static, but that's okay. It does have a very meaningful effect to the beneficiaries. So the revenue ruling talks about an indirect benefit to the beneficiaries. An indirect benefit to. So if you look on page 149, the third full paragraph, the last sentence of the third full paragraph. Therefore, an NOL carryback of an estate or trust may result in an indirect benefit to the beneficiary by reducing the DNI of the estate or trust. All right, you guys are all good? So let's do this, the problem on page 149. It relates back to problem 2-2. Let's start back with 2-2 from the end of chapter 2. And we're going to have it, it's on page 103. Remember what the tentative taxable income was?
$83,280.
Right? without saying it out loud, can everyone here try, and then we'll go around the room, take 1 minute, come up with a D&I figure. Come up with a dollar figure for D&I. That's, remember, we left, this is TTI, tentative taxable income. Remember, we didn't get the full deduction because we had to back out. It's the $2,000 worth of deduction. We didn't get the full $2,000 because part of those expenses was allocable to tax exempt income, right? Remember? Remember? Yeah, for those who forget, I'll just remind you that we had the numerator of 40, denominator of 140, and times 2,000. So disallowed expenses were $580 of the 2,000. So only 14,420 was allowable. Right, that brings you up to date. Take 1 more minute, tell me I need a dollar figure for the D9. Ten more seconds. Tina, do you have a number? Sheeta? No, you don't have a number yet? Nobody? Just apply code section 643. Anthony?
I know I add back municipal bond interest. That's 123,280.
Just give me a total.
123,280.
How much?
123,280.
123,280. Lisa?
122, 160.
122,
160.
122, 160. Yeah?
It's 123,60.
123.60?
580? No,
You're not sure? David?
122,700.
22,700. Adrian? That's right. Dale?
85,000.
85,000. Jenny, final number?
123,000.
123?
Common.
Bingo. Jenny, how did you get there?
Plus 300.
Okay, doesn't it say D&I, start with tentative taxable income? Right, Anthony? You just add back. Remember, we don't, in the tax return that we looked at, when we looked at Schedule B, remember, we didn't have to add it back because it was never taken into account. But here, remember, to get to the dollar figure, we already reduced it, which means we have to add it back. Everyone agree?
Yep.
Right? We don't have, any capital gains, right? So we don't have to subtract out, right?
No, that's not income. Damn
And then we have to add what? Jenny?
40,000 municipal
Municipal.
tax exempt income.
So how much do we add?
Actually, it's adjusted tax exempt income.
How much is the adjusted?
It's 40,000 minus
The expenses allocable to it, right?
580.
So it's actually 39,420, which is what? It's the 40,000 less the expenses allocable to it, which is the 580, right? Ah. So the total is 123. And then, guys, this is not, this would, on an exam, be a fair question because all we're doing is taking code section 643 and just taking tentative taxable income and adding it back.
It would help if I used the right number, but otherwise, yeah.
All right. David, you got that? All right. Assume that the problem in trust 2-2 realized $200,000 of long-term capital gain. Assume the gain is allocable to principal under state law, which is a governing instrument. Calculate the trust D&I. The trustee distributes only fiduciary accounting income. Okay? I'm going to try to keep my mouth shut, guys, which is always, as you know, hard to do. Compute the D&I, guys. Go for it. Take a minute. Try your hand at this. So we have one more dollar figure to add here and see what bearing it has. All right? In this case, Lisa, do you have a number? D&I? Anthony?
The same.
The same, Patrick?
Yeah, I think it's the same.
It's the same? Brett?
The same, you wouldn't adjust it for the capital, correct?
I don't know what you mean by
That's
that.
what,
But the gain was allocable to.
Say again, Lisa?
The gain, the capital gain was allocable to the principal.
Principal, not income.
yes, so D&I is not increased, right?
Well, let me ask you a question. What happens to tentative taxable income?
Goes up 200,000.
Everyone agree it goes up by 200,000. Agreed?
Right.
Agreed? Yes? No? Maybe?
Yeah.
But then, Dale?
Then you pull it out again after, so right after 39,000, now you pull out the 200,000 because it's allocated to principal
Right.
and not distributed out.
Yeah.
Static. D&I is going to stay the same. Everyone agree? Some of you might have got it flummoxed, but don't make it harder. And notice, we didn't have to change anything here, right? Under Manufacturers Hanover, D&I did not include capital gain. It did not change, right? The denominator there, right, David? Everyone see Manufacturers Hanover at work here? Easy, you see that? Nobody, you got it? So that's your answer. This is just a simple example of Code Section 643. Ready for question B? Calculate the trustee and I if the trustee distributes not only fiduciary income, but $200,000 of principal to the beneficiaries. So, remember, problem A, what name would we put to trust A? In problem A, what would you call that kind of trust? Anthony? What would you call it? Frustrating? No, the name of the trust. Dale, you were going to say?
I'm not sure what you're asking me.
Yeah.
Put a label on the trust.
Simple trust.
It's a simple trust, right?
Yeah.
Everybody agree? Simple trust. Just want to make sure you see that. It's a simple trust. Question B, is it a simple or complex trust?
Complex.
Complex, right? It's not only paying out income, it's paying out principal too. Okay, everybody agree? So, does that change your D&I figure? It also distributes out the capital gains.
Are we saying that 200,000 principal is capital gains? Are we allowed to make that distinction, or I don't know?
Well, I think what the authors were trying to hint at is this trust has millions of dollars,
Okay.
and it also distributes now $200,000 of the million.
Okay.
Will D&I include the capital gains?
No.
No. Everyone agree? Problem B. And picture each one of you as a beneficiary of this trust, okay? Each one of you are happy because you're going to get the fiduciary income. And pretend for the moment, I'm the trustee. And I think you're going to be happy with me tonight because I'm going to distribute to each of you, in addition to the fiduciary income, I'm going to distribute $200,000 to you, right? From the trust. What is your expectation as a beneficiary? What do you anticipate being taxed on?
Fiduciary accounting income.
You're anticipating being taxed on the fiduciary accounting income, right? Not the capital, not the principal of the trust, right? That's just Solar being a nice guy. He's making a discretionary distribution to you. We know under Code Section 102A, right? Or principles of income, this is not income I'm distributing principal to you. The D&I, the capital gains, and by the way, and Tina, I'm going to pick on you for a second. Is the trust in problem B going to have to pay tax? And I don't need an exact tax figure, but would the trust have to pay tax? And if so, can you make up a number what that dollar figure would be? What what, on the 1041, what will be the bottom line number that the trust will have to pay tax on? Not what is the actual tax? What will be, Brett, do you have a number in mind? Tina, you can throw out a number too. I don't want to give up.
The amount that the trust would actually pay tax on?
Yeah. Patrick, do you have a number? Just- Anthony's, Adrian, I'm saying, is, or Anthony, chomping at the bits. David?
200,000.
David, did you say 200,000? You'd be close, but remember, it gets a $300 personal exemption because it pays out all income. So it'd be 197, 700, and 199, 700, right? Everyone agree? Again, Tina, all I'm saying is eyeball it. If the money is stuck in the trust, the capital gain, who should pay tax on it?
The trust.
The trust. Now listen, I mean, again, with clients, my advice to you is don't be so cavalier and just say, this is probably what, tell the client, let me go back and I got to run the numbers, and then run the numbers, but and see if the computer comes up with the same thing your instincts tell you. But all I'm just pointing out is you should have a gut. Now, question C. Calculate the D&I if the trust distributes not only fiduciary accounting income, but also $200,000 of principal to the beneficiary, and thereafter only $50,000 of principal remains in the trust. Okay?
So for the B, the DNI is still the same.
Yes, the D&I is still the same in problem B. So in problem C, come up with a new D&I figure.
We're gonna have to change that number.
Don't say it out loud. Take a minute. Come up with a number. I'll try to help you out here a little bit. What are we going to include in gross income? Dividends? Chrysler? I think New York City is 0. Rent, I think we said is 20. Long-term capital gain. So $300,000 of gross income. Now, let's talk, about deductions. So we can figure out tentative taxable income. What deductions can we take, guys?
Your property taxes are 15. And then an allocable portion of the 2,000.
Personal exemption of 300. And what proportion of the 2,000 can we take? What proportion is allocable to tax exempted the 2,000? Right? Which would be disallowed, and what proportion is allowed, right?
Yeah.
So we have to have how we did it before? Okay? Patrick, what's the denominator? And see, Anthony, if you agree. Say again, Patrick?
240.
Your answer is denominator is 240.
340.
340. 340.
Yeah.
Anthony, agree?
I agree.
Dale?
I went with 290.
Rashida? Denominator? How much? 240. Tina? 250. Yoni?
340.
340. Jenny? 340. Thesa? Sal?
340.
David?
100.
100. Is it denominator? Remember, the denominator includes the income, okay? The 50, 30, 20, right?
Tax exempt.
And the tax exempt, right, which is 40, right? So 140. But it also includes, right, now D&I includes how much of capital gain? Say again? 150, right? Remember. Remember, 50 is being retained, 150 is being distributed, right?
That's right there.
So what is the denominator? It's 140 plus 150 is 290.
Yeah.
Again, where did the 290 come from? It's the total income of 140 plus 150 of the capital gain because that's what's being distributed. So if you do that, the amount disallowed is 276. 276 is disallowed. $1,724 is allowed. I repeat, 276 disallowed, 1,724 allowed. So the tentative taxable income is 82,976.
282,000.
What was that? I'm sorry?
282,000?
This is the capital gain.
282.
300 minus 15.
Yeah. Hold on 1 second. I got to think about this for 1 second. Okay. Agreed. Yes, absolutely. So this is tentative taxable income. Now, figure out D&I. Don't say it out loud. Figure out D&I. Good.
I have a question about 290.
Which number?
290?
Yeah, it's 140
Yeah.
plus the 150 capital gain.
I saw that they distributed the 200,000.
They did. Look at it, the fact pattern. They said they kept 50,000 as a reserve. Right?
I didn't say reserve.
Only 50,000 of principal remains in the trust.
Yeah.
That it wasn't distributed out.
Yeah, but does that, wait.
If you read the examples and the regulations, that's going to be presumed to be the capital gain is going to be left stuck in the trust. I promise you, Zal.
Oh, okay. The total amount 200,000.
Okay, D&I, Adrian.
323.
323, Patrick. D&I? 323? Brad?
Yeah, 323.
Let me just ask you, and I think I know why you're coming up with that number. But look, well, I'm not sure. Oh, I know why you're coming up with that number. Look, what do you add back here? Everyone, unison. What does the code tell us to add back?
The $300 after.
$300, okay, everyone agree?
Right.
Gotta add back the personal exemption, right? And we also have to add, how much tax exempt income back? 39,
724.
39, and I guess I simplified it, 720. I mean, it depends on your rounding, right?
Okay.
Seven, well, 724, you'll see. And then, what else do we have to do, guys, with respect to capital gains? Do we have to add it back?
The portion is not included in the DNI.
We have to include the portion that's not, which is how much?
50,000.
50,000, right? Because we have to include 50,000, so D&I becomes 273. D&I, 273. Patrick, you see, that portion, the $50,000 was not distributed out, right? So that has to be subtracted.
Subtracted, yeah.
Normally, we would subtract out all the capital gains, agreed? But here, we don't, but that makes sense because who's going to be hit with the tax burden, guys? The beneficiary, right? But they've got the money. So we're not going to bleed for them. The trust only has 50,000 in capital gain. So, Tina, sorry to pick on you. You want to give me an estimate on how much tax will the trust have to pay tax on?
50,000. You mean the trust?
Yeah, the trust.
50,000 minus the 300.
Yeah, the $49,700, right? Everyone agree? You feeling a little bit better than, I mean, maybe some people, you feel further loss after tonight. If you recall, my optimistic goal was by the end of tonight, you were going to feel better about the material. Maybe that was Pollyannish on my part. But by going through this exercise, guys, and I'm hoping I took away some of the mystique of Subchapter J by looking at actual return and seeing that notwithstanding the complexity of the cases and the rulings and all that, that when you look at Schedule B of the 1041, it's going to be manageable, and these things will be done many times automatically by the computer, but you have to be able to figure out why the computer is coming to certain conclusions. You're very replaceable if you can just say, or the only thing you can say is, oh, the computer said so, let's end the conversation. That doesn't get you very far when you're talking with clients, all right? In this day and age, you really have to be able to articulate why things are. And also, by knowing why things are, you can do some tax planning, and you can decide maybe we shouldn't make a distribution this year, because maybe we should let the trust or state pay the tax, make the distribution the next year, when there's going to be a short year, and we're going to make the distribution at the first week in January when the trust has virtually no income, and it won't pull out any D&I because there is no D&I. Why? Because you start off with tentative taxable income. If it's a short year, there may be zero income, right? I'm not saying, all I'm saying is by knowing how these things work, there's ways to do tax strategies. Bill.
Just doing that first 2 weeks of next year thing, well, I guess it's on termination. I was going to say, does that mess with that 65-day rule thing?
No.
Okay.
No. So let me just tell you, or give you some foreshadowing again of things to come. That we are going to, beginning on page 150, talk about distributions to beneficiaries. I will say this, that I know for a fact, guys, that if you go through this, the problems on page 177 are the kinds that you're going to see a lot of on the exam, okay? So those are the real problems, all right? If you want, read up to page, we're not going to have a lot of reading for next week, okay? This way, I'm hoping you can catch up, catch your breath, and really hone in on this. We'll probably get up to page 182. Maybe have a little bit of time to talk about the separate share rule, maybe not. And we will probably talk. I know you're going to be, I'm excited personally, so maybe you'll share this. We'll go through like example 3, and we'll look through, if you look at example 3, it's a simple trust with capital gains, and we'll see how that ends up on a tax return. So my message to you is if you could reread the regulations with respect to the examples, okay, regarding D&I. We do not have a lot of reading. Try to reread what you looked at, and if you have questions, let me know. But again, the problems on page 176, 177 are going to be your keys to success on the midterm, okay? So do try to make your mistakes outside the class. You'll learn a lot more making the mistakes coming to class than never having to try, never having tried. I'll see everyone next Wednesday.